Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for December 15th of 2024. The chart pack today, let's go ahead and get started with inflation data that came out both on the consumer and the producer side. Here we've got producer prices first. You can see that that came in a little bit ahead of expectations. We've got a number here that was up about 38/100%. So you can see, we were in a bit of a downtrend and we had a little bit of a uptick here. But if you look at the core number, it was pretty much in line, and you can see that downtrend is still relatively intact here. Now, if we look at final demand for foods, this is really the reason why the overall number was up for the month. And you can see that we had a little bit of a spike. Again, these things are noisy over time as we talk about, when we refer to the monthly data. Very interestingly enough, we've had this spike. Don't think that we'll continue to see that because, if you go back years and years and years, you say that these things tend to reverse themselves or mute themselves out over time. Here we have the consumer price index, and I'd say everything across the board here on CPI was in line. We had CPI that reflected a little bit of an uptick on a monthly basis relative to the last several months of reported data. And again, this is the November survey that we're talking about here. If you look at core prices, continue to be just a tad sticky, maybe a little bit higher than we want, but again, it was very much in line with expectations. Here we have core goods prices. They were up 0.3%. You can see that reflected here. So that was up a little bit more. And, we hadn't seen goods prices come up that much in quite a while. You can see new vehicles and then used vehicles really had a lot to do with that. I'd say probably the majority of this uptick was reflected in these particular categories. Now we talk about core services. Now this is much more meaningful when you get into the grand scheme of things. So it's much more meaningful in terms of overall inflation and its influence on inflation. You can see that those numbers are continuing to trend down. We're just under 0.3% positive on the month for the November reading. You can see OER, which is owner's equivalent rent. And we talk about rent a lot here, right? And we talk about what are the biggest influences on the stickiness factor of inflation. And we've always said it's been rents and wages. And here we go. Right here, we've got some downward trend in rents, which is really good. It's something that we've expected for quite some time. It's been very, very pokey in the data because we see that observed rents in the marketplace have come down, but the OER calculation has been rather sticky until this month. And so that number was down around 23/100% and reflects a notable downtrend. So we want to monitor that, but good news on that front. So now we'll turn our attention to the PCE, personal consumption expenditures inflation data. This is what the Fed cares about most. You can see here on the left-hand side, we've got data that reflects housing core goods and what we call kind of the super core, if you will. And the expectation is that inflation is going to come down. Now, we do not have the November reading. That will come a little bit later on this month here before Christmas, but the number is expected to come down in several different areas. The supercore is expected to decelerate a little bit, as well as housing, which you just saw is already in a bit of a deceleration mode. Now, on the right-hand side, we have expectations with regard to where things are trending. We've got inflation, core CPI. You can see here, perhaps bottoming. I'm not quite sure, but obviously we saw a core CPI number that was well within expectations. Goods prices, we did see a little bit of change in goods pricing, which we hadn't seen in several months, but there was an explanation for it. We saw that. And then we've got services and services ex shelter both trending down. So this is really just another iteration of this. And, the argument that's maybe made in the particular research where this particular slide came from MRB Partners. They're trying to make a case that there is no slack in the economy, and so when that happens, you tend to see higher prices. But in a second, I will try to debunk that in the sense that we've got more capital spending coming online, and we certainly have more manufacturing capacity coming online. So all that data leads us to expectations heading into the last Fed rate meeting of the year here. In the left-hand side, you can see here very clearly that we have a high probability of a 25 basis point rate cut at this meeting heading into the new year. I think in many respects, perhaps the Fed is looking at this as maybe the last time to get a rate cut in before the administration change. And we're going to talk about tariffs and some of the rhetoric surrounding the inflationary impact of that in the chart pack in a few slides. But very high probability of a rate cut. I'm not so sure that they should cut, but I think it's maybe 6 of one, half dozen of the other. But anyway, strong feeling that we're going to. Now, looking at the rate forecast for next year, market implied still around 4%. So that brings us down, maybe 75 basis points or so, roughly speaking. And then you've got the Fed funds rate target as defined down here about 3.5%. So reasonable decrease heading into next year, just like this time last year. There was expected to be 6, 7 rate cuts. We certainly didn't get that. And I think, the forecast for next year is apt to be potentially off the mark. We'll just have to wait and see. But as I think you'll see in the ensuing slides, that building a case that we're heading into 2025 with a bit of economic momentum. Here we have a bit of a colorful chart here, maybe reflecting some holiday colors, but what this is a chart of the number of major economies that are expected to witness growth. And the red represents those, the percentage of those countries, major economies that are expected to contract. And what you will notice very clearly here, 2025, we don't see any red. So the expectation is that we're going to have growth across the board, which is something, honestly, we haven't seen for a while. We did see it back in 2021, but that was bouncing back from the pandemic. And so naturally you're going to see that. But again, you got to go back to 2017 and in a more normalized environment to see what we're looking at potentially for next year in the sense that you've got a lot of boats rising across the world in terms of economic growth. Here we have something from UBS talking about growth expectations. Again, this is looking out into next year. So U.S. real GDP by UBS's estimates looking to be just shy of 2%. You can see how that compares with the rest of the cohort. You've got EU about 0.9, although it's important to note that EU 0.9 actually represents a better number than what they saw this year, and then Germany looking a little bit less than that. Japan and UK looking a bit stronger. So U.S. is leading the way in growth expectations, but as we saw in that previous chart, there is widespread belief that we're going to have global economic expansion next year. Here we have some U.S.-centric data. We've got household and net worth estimates, and we have real net worth, which is, again, is discounting nominal net worth numbers by inflation. And so granted, we've had more inflation lately, certainly, after the pandemic, we have that surge, but where we are right now in real net worth is we've just passed that pre and just slightly post-pandemic high that we saw in overall net worth. Here we have disposable personal income. You've seen this in various iterations in the past, but getting past the noise of the pandemic with the transfer payments and whatnot, you see here very clearly that we are trending ahead of the baseline established 2016 to 2019. So a lot of seed corn, a lot of, again, if you look at disposable personal income, you could say, hey, this could be inflationary. But this has really been the lifeblood of our consumption, looking back over the last couple of years. Now we have sentiment and discussions around consumers with S&P 500 earnings calls. And so the higher this number, the more positive sentiment there is in the tone of the conversations about consumers that are in these earnings calls, meaning that with this number going up, that there's a lot more positive sentiment that CEOs and C-suite executives feel about consumer spending, so on and so forth. So this tends to corroborate what we saw in the hard data in that last slide, is that you have purchasing power that's still relatively strong, and you have some real growth in that area net of inflation. Now we'll talk about small businesses. This is the NFIB, National Federation of Independent Business. This is, I think, these slides are very important, and we get this data every month, but you can see some very notable and reinforcing trends here. So you got the overall survey here, which the actual number blew out estimates, and you can see that has trended much higher over the last couple of months. You can see the outlook for general business conditions blowing out here on the positive side. These are very strongly positive numbers. And then consequently here, not only do you have strong sales expectations, I mean a real resurgence in that, but you also have a decline, a little bit of a decline in the uncertainty index. Now, granted, some of this data is coming to us after the election, so there is some kind of a post-election euphoria to some degree on the part of some of these respondents. So I think let's be careful not to over extrapolate data, but clearly the sentiment heading into the new year is very strong from a small business standpoint. As we look at NFIB data continued here, we've got small business hiring plans. So, obviously, if the sentiment wasn't high, you wouldn't see hiring plans move higher, and that's exactly what's happening here. And also, we've got compensation moving higher as well. So with inflation that seems to be ebbing a bit and compensation moving higher, that means real wages are going up, which means that it's just more feedstock into the consumption mechanism in this country, which is a good thing, and leaves lots of room for optimism heading into 2025. I mentioned this earlier, but on the left-hand side, we have CapEx plans. This is capital spending, and very clearly, you wouldn't have numbers spiking higher like this if there wasn't positive internal sentiment on the part of managers, owners, and C-suite executives. So again, very positive heading into the new year. And then as we look at manufacturing spending in this dark blue line, we've talked about this in the past, but this data coming at us from B of A, Bank of America, you can see the acceleration relative to overall construction spending, which has trended positive. Again, this is a multi-year look, and this is just raw billions of dollars. So, and I believe this is nominal, so it's not adjusted for inflation. But what you see here in the manufacturing side is an acceleration, and I think that's very important to the health of the economy, and honestly, a very good from the standpoint that we've had this rolling recession in manufacturing, and that side of the economic coin is looking better. Here we have mergers and acquisition activity. We're seeing, and as it's defined in this chart from UBS, they call it a green shoot. I would agree with that. I mean, we had a lot of deal flow after a huge contraction during the pandemic, and and we're not back up to pre-pandemic levels, but M&A is picking up, and 2025 is expected to be a relatively good year. Here we have real retail spending. Again, the strength of the consumer. We've talked about real wage growth. We've talked about hiring intentions moving higher, as well as compensation plans. It all feeds into this that we're looking at here. And so you go back before the pandemic, and we saw just as many negative months as we did positive months, looking back on an annual basis. And that data is on the wholesale positive here. And so we're seeing, even amongst these various cohorts, whether it's low to high income, we're seeing, by and large, positive trends here in real retail spending. Labor shortages, we've talked about the labor market a lot. So the share of management teams discussing labor costs. So this is not as much of a concern as it was. And we knew that inflation has come off. So again, we've already kind of, hinted at, hey, we've got some relief in owner's equivalent rent. That is one of those two legs of that stickiness factor in inflation. Here's the other leg, and we've got labor cost, at least discussions amongst management team. That's coming down, and then labor shortages. That discussion topic has gone down as well, and so labor market seems to be kind of stabilizing as we have seen little modest increases in unemployment rates, but again, labor market overall is relatively healthy. Here we have price pressures in the overall supply and production chain. You've got, that number is coming down. So we've got easing pressures, looking at it from a production and delivery standpoint. That's all very good. You can see in the light blue, that's the PCE inflation, which you heard me mention in one of the early slides, is that number is expected to fall in the November number that we'll get here in a very short order. But that is expected to continue to trend down. And you can see the correlation here between price announcement indexes, or the price announcement index rather, and the PCE number. There's a real tight correlation there. So expect that to come down as well. Here we have tariffs. Now we're going to start wading into the whole tariff equation. And again, we don't know what's going to happen. I tend to think that a lot of the tariff discussion is posturing for getting something in return. It's been utilized for that mechanism before. I can't honestly think that we're going to have the magnitude of tariffs that are being discussed, but I do think tariffs are apt to move higher. And we're going to talk about that a little bit. But again, tariff discussions are definitely moving higher. So that's something that we want to monitor. Now we'll talk about some of the impact of tariffs on economic growth and inflation. And there is a lot of debate, because the tariffs that were enacted back following 2018, in themselves, they didn't drive a lot of inflation. Inflation was actually very low until we got into the supply chain problems, and we saw that basically 60+% increase in the money supply following the pandemic with all the assistance programs. That's when inflation really started. So, I mean, in the early days of tariffs, even looking at it from a lag, we really didn't have that much inflation. And so that, I think, calls into question some of the speculation that's out there. So now from a GDP standpoint, when you think about tariffs, I mean, you're asking consumers domestically to pay more for things that are imported. Well, if you don't increase the money supply, and we know that the money supply is actually decelerating right now, if you don't increase that money supply, they're either going to pay for that item, in which case inflation for those items that are impacted will go up. Or they will substitute. They will buy domestic produced items, even though they may be of lesser quality, but they only have a fixed amount of seed corn to use, right? Because the money supply is not increasing. So, you tend to have less overall inflation with tariffs unless you increase the money supply. So, but having said that, you do tend to have, a fixed amount of cash that's chasing, the same amount of goods. And so I do see the chance here that we have, some economic growth degradation from tariffs. And on the low end here from UBS, they're talking about, minuscule impact. On the high end, they're talking about something that's probably more like 1.5% of impact to annual GDP. Again, this is wide enough you could drive a truck through it. Inflation, they are expecting it to be inflationary, but this is, I think there's a lot of academic thought here that inflation, again, in an environment where you are, you're actually decelerating your money supply growth. Uh, you know, this is going to be harder to achieve, I believe. So this is, I think, the magnitude of what's being discussed out there. Can't find a chart that does a better job of it than this. And obviously, you got to go back to the late 20s, and you've got Smoot-Hawley back there, and this is going to eclipse that by some measure. You can see Trump one, seemed to be kind of a baby step, if you will. But again, I think that this is going to be very problematic. I just think that there's a lot of posturing to get concessions on immigration, to get concessions on, fentanyl and some of these other kind of topics. And I do think, from everything that I've read from a foreign policy standpoint, particularly Canada and Mexico, there will be some capitulations there, and then particularly Europe, there'll be more. Now, China is kind of cut from a different cloth, so we'll have to wait and see on that. But it could be that this number looks something like this instead of this. All right, now we'll look at some other forecast here. Looking at it from, I believe this is Charles Schwab and their research. They're looking at base case here. This would be the 2025 GDP growth forecast. They're currently looking at U.S. GDP is somewhere about 2.25. Global GDP looking something a little bit more like 3.25 here. And so if there is a trade war that is precipitated from the tariff policy that is being discussed, and that would have an impact here of, call it about 0.5%, if you will, on growth here in the U.S., and then far less impact here on the global scene. Now we'll talk a little bit about the dollar here before we transition into the equity and fixed income markets. You can see here dollar remains very, very strong. A lot is behind that. Obviously, economic growth relative to the rest of the globe is one. The aggregate level of interest rates relative to the rest of the world is another. And I would expect the dollar to remain strong, perhaps maybe not as strong, but we'll have to watch the pace of interest rate changes, which will of course be dictated by the levels of inflation and aggregate levels of inflation and relative changes in inflation, which I think we've been talking about earlier today, that those should continue to come down. So I see the dollar remaining still relatively strong, although it may not be at the levels that we're seeing right now. On this slide, we have S&P 500 revenue, something else to get you a little bit motivated here heading into 2025. We've got average growth in real revenues, excluding the energy sector, which could be quite volatile based on oil prices, but you've got that average number about 2.6, and during expansions you've got it around 3.5%. Right now we're tracking actually close to 5. So again, that average is somewhere around here. If you go back to 1970, you can see how the data oscillates over time and how it varies during contractionary and recessionary periods. It's actually a pretty good predictor, but sales growth is clearly moving higher. It's been positive. For all the reasons that we've already articulated in the chart pack today. We've got expansion, we've got small business feeling better, and that is leading, small business feels good, then generally speaking, large business as defined by the S&P 500 is also going to feel relatively good. So again, good data heading out of 2024 and heading into 2025. On this slide, we have sentiment, the name number. This is the Institutional Manager Index, very optimistic. We've been watching kind of a notable rise throughout the last, probably the last 6 months here in overall exposure and sentiment. This actually happens to be a direct exposure into the equity market. So we see increasing allocations, increasing confidence levels, so on and so forth. Here we have, something that's developed here lately. Again, with all the optimism we've seen, we have had a bit of a pullback, and we say, November was a really good month. December, a little bit more lackluster, but I think we've had a bit of retrenching, and something that we've seen here is, for all the improvement in breadth that we had during November, we've had a little bit of a reversal, and so we see the Mag 7 here. Beginning to reassert itself, relatively speaking. And this really happened almost like at the beginning of the month, where we got the equal weight index, which is kind of underperforming, although, relative returns for the month have actually not been bad. It's just that we've had this decreasing breadth as the Mag 7 has taken hold. We see the number of S&P 500 members percentage-wise above their 200-day moving average, and that number has dropped here a little bit over the last several weeks. But that's not to say that we haven't had a lot of liquidity, because we certainly have, and you can see that here in this red circle. We've shown you this chart before. Macrobond does a really good job of tracking this, and so here we have the MSCI US index, which is kind of a proxy for domestic stocks. You can see that in the dark, the black line here. And then we've got the group of 10 excess liquidity leading indicators. So this is looking ahead 6 months, and you can see that it does a relatively good job of foreshadowing equity increases. And so based on this, we would expect there to be a continued positive influence on the equity markets, at least from a liquidity standpoint. And then over here, we've got small caps. We've talked to you about this before. When we talk about breadth problems, small cap has kind of struggled at times, but when we have numbers like we see now, I mean, it puts small caps in a very attractive light. So now we have basically a full chart with two exhibits that I put in here from B of A's global research. And so, basically, corporate profits and how they tie into certain cap levels. And these charts talk about corporate profits as they pertain to small caps. So, corporate profits have mattered a lot more to small cap companies than the political backdrop. You can see here that, Republican, Democrat, kind of almost a push. And what you'd expect here, the differential between positive and negative growth. And then accelerating and decelerating, a little bit of a gap, but basically this is the percent of years post World War II where we've had positive small cap returns. And again, I think the key thing here is it really doesn't matter who's in the White House, and these things are stats that you would expect anyway. Now transitioning over here, we've got basically small versus large cap relative returns, and then again talking about corporate profits, and this is basically the percent of years in the post World War II environment in which small caps outperform large caps based on these various issues. And so again, Republican, Democrat, doesn't really matter. It really doesn't matter. And and then the number of years when you have positive growth, just as you do over here, when you have positive EPS growth, you tend to have pretty good performance out of small caps, and then accelerating earnings growth as well. Again, good news for small caps, because that's kind of the environment that's setting up for 2025 for us, barring a unforeseen issue related to tariffs or geopolitics or whatever. Here we have market volatility. We've talked about this a lot. Volatility has been really, really low, and this is realized volatility. And what's interesting is macro uncertainty has also gone down, which again, after the election, there's tariff discussions, there's geopolitics in several fronts. But markets really not terribly concerned about that. You can see risk-adjusted returns across some of these indices. This is the equal-weighted S&P 500. That's S&P 500, NASDAQ mid caps, and the Russell 2000 here. And you can see year-to-date risk-adjusted returns, basically looking positive relative to the longer-term medians here. Now we've got option adjusted spreads, OAS is what OAS stands for, and that just means what's the spread in yield for investment grade bonds in this country over the comparable maturity treasury, and this would be the same for high yield. And these spreads are really tight. So if you wanted an indicator that told you that the market is not concerned with economic malaise or downturn, this would be one of the key ones. So you would typically see these spreads begin to widen out quite a bit if the market was pricing in meaningful risk in slowing economic growth. Again, you can see very clearly that's not the case. And you would particularly see it in high yield if they felt like defaults were really gonna pick up, which they have been, but not anything to make us very overly concerned. And we look at fund flows too. So we've had a lot of flows into bank loans. Again, bank loans are probably some of the items that would get tagged first if you had a credit meltdown. And you don't see that at all. You see positive fund flows. You see money flowing into gold, precious metal, commodities, corporate investment grade bonds, if you can believe it. And even inflation protected, treasury inflation protected securities. And and then when you look at different types of assets too, obviously Trump and his position on cryptocurrencies, so you naturally expect fund flows there, bank loans, money market mutual funds, leverage funds, and then you see a whole host of equity here. Very interesting to watch these fund flows, but I'd say that these two are the most telling of any data on this chart, is that the market really isn't pricing in a lot of risk at this juncture. Here we have triple B debt at risk of downgrade. So I just got through telling you that spreads are really, really tight, but we do have some stress out there that we need to pay attention to. And right now we've got in this particular line, we've got the percent share of triple B minus debt with negative outlook in that index. And so we have seen this pick up a little bit. And what it tells you is that you have companies that are marginally investment grade, and triple B minus would be the delineation point on that. So anything rated below triple B minus would be considered junk, if you will. But again, like we just saw, high yield spreads or junk spreads, really not a concern right now, even though we have companies that are on credit watch. So we've got here the spread between the 10-year Treasury and the 3-month Treasury, and lo and behold, after several years of inverted yield curve, that even on the 3-month to 10-year, we're at the point of disinversion, which means that we've got the 10-year yields that are moving back above the 3-month, which is a profound development. And the other thing too, which really kind of highlights something else that I've noticed over the last year, is that we've actually had more bond volatility than equity market volatility. And that chart that I showed you on volatility a few charts ago, that was equity volatility has been pretty low, but bonds have become much more sensitive to economic data releases here. And you can see how that has picked up considerably in really the last couple of years. Here we have a chart actually out of Bloomberg, and what's really interesting here is that oil estimates, even despite this global economic expansion outlook for 2025, that you've got oil demand coming out, the demand estimates for 2025 coming out of OPEC going down. This is the estimate in 2024, so at an aggregate level, we're looking at something more like 1.6 million barrels a day, and then now we're looking at something that's a lot closer to 1.4 for the next year. Last chart, kind of an observation here. If there's ever a chart that you wanted to take a look at to convince you that private sector is much more efficient and productive than the public sector, this would be it. So you've got basically private sector productivity moving higher, public sector productivity is actually going the other way. And so this argues very strenuously to keep more resources out of the public sector, get government out of business and let the private sector do its job. That's all we have for the chart pack this week. I hope you have a great week, and we will talk to you again very, very soon. Take care. Bye-bye.